there is an inverse relationship between the value of your property and the interest rate. The value of a property will go down because the interest rate is pretty much the rate of return for an investor. In a mortgage situation, the interest rate is the rate of return where you borrowed the money from. The movements of interest rates in the economy are cyclical. At one point, they go up, and they are a reflection of the macroeconomic environment in any country. The macroeconomic environment across the world is becoming a little bit challenging. So that is driving prices of assets down. So it shouldn't surprise people, or it shouldn't worry people, the fact that the asset prices are temporarily going down at the moment. It's part of the cycle. But this downturn historically has always been known to reverse. One of the things that you find that is troubling for investors at this time, especially property investors, is the fact that there's a lot of talk about asset values have gone down, and this can affect someone's emotional state. So it is important to keep everything in perspective, in that this is a temporal season. It's a season. It's not something that's there permanent. If you make decisions on a temporal situation and make a permanent decision to sell, you will lose money. So the concept of asset values going down, it's applicable even to shares. Shares are also going down. My point is that try to manage your emotional and psychological health. Suffice to say that how you manage this emotional health, will also affect your physical health. So very important, these two things are connected. Keep things in perspective, and we know there's going to be temporal pain until the interest rates starts going down again. So what does that mean? It means that we are in a temporal period of pain, but eventually when situations reverse again, it will be a period of excitement again. So how you manage the transition from a painful period and persevere through the painful period to a period when the reverse occurs again is very important. Manage the conversation that you have around interest rates with your family, with your husband, with whoever you have as your close confidant. The more you keep talking about the negative side of the impact, the more it weighs you down, and the more it pushes you to try and sell and sort of surrender. Most investors can make a very bad decision this period. Equally, if you ask people who are renting at this particular time, you will find a different narrative. Those that are renting have only one advantage, but equally it doesn't make it much easier for them either, because rents are going up. Because as property prices go down and interest rates go up, there is an inclination to recover more money from the renter. As it becomes more expensive to service and the mortgage, the property owners want to be remunerated more, so that pushes up rents. The second thing I want to move on to is I want to make a distinction here. During the downturn, this is one of the best times to invest and bargain. It might sound counterintuitive, but when interest rates are low, everyone has access to money to borrow. And when you go to an auction, there are many people who are surrounding the house. What this means is that because fewer and fewer people are going to an auction now, because everyone is afraid, because people are listening to the news, and this is being hammered in people's heads again and again, that interest rates are going up and be careful, people are going to lose property. The media emphasizes things that are not necessarily that bad sometimes. So just be careful how you listen to the media and how it emphasizes things. This is the best time to invest if you have extra cash, because when you then go to the auction, there are fewer people. You can actually bargain a better price even before the property goes onto the auction. If someone thinks this is a good price, you can actually get a good price. But also it's a good time to buy, because some people who are under pressure are selling. So in terms of buying, this is the best time to buy. Even if the interest rates are going up and the deposit that is required is a little bit more, if you have it, you will be able to buy property at a much cheaper price ahead of the next boom again. The other side of investing during this time is the maintenance side. If you already have bought property in this time, what you need to do is a couple of things, actually. The first is to make sure that your property, if it's investment property, it is giving you cash flow, or I would rather say cash inflow. In other words, it is being rented. There is income coming in from that property. Never skip a month or a week with the property empty in this period of time. You can't afford it, because every dollar counts. So make sure the property is cash flowing. The purpose of an investment property is to generate cash flows. More so if those cash flows are positive cash flows. If it can't generate positive cash flows, at least let it generate cash flows. What is the difference? The difference is this. What we call positive cash flows is where the property is earning is more than enough to pay for its bills, for the mortgage, for the repairs, and so on and so forth. That's positive cash flow. And if you generate more, then you are generating positive cash flows. If it's generating less, then it's generating negative cash flows. The point I'm making here is make sure that it's generating cash flow. At least it's bringing in cash. Why is it important for it to generate cash flows? Because it helps you maintain the property. Say, for example, it's generating negative cash flow. If there is a future for that property, then hold on to it. Supplement the income that is coming from that property from your own earnings. Or if you have other properties that are already generating positive cash flows, try to leverage or balance out the property generating negative cash flows with the properties that are generating positive cash flows, so that you are able to pass through this period of downturn. If you are going to sell this time, there is a high likelihood that you will not make a profit. So what does that mean in practical terms? Make sure that you are in touch with your tenants. Make sure you understand what they need, what they are in there. If they have issues, make sure you attend to them. In other words, make sure that you do everything you can to maintain your tenancy in the property. And in order to minimize your costs, you also need to be extra careful, extra vigilant in terms of how you manage your finances coming from that property, because ultimately your main goal is to make sure that whatever is coming from there, it remains or becomes positive, or you can capitalize as much as possible of income coming from those assets. Make sure that you reduce your costs, but not reducing costs by not repairing, but reducing costs by making sure that you shop around. Whatever you can do yourself, do it yourself, and make sure you are watching over what's happening on your property, because it's your income generating asset. Don't buy a property and be totally out of touch with what's happening at the property where it is. Perhaps it's even much more important time for you to do inspections. If you were not doing inspections that often, if you're doing inspections maybe once every year, you probably might want to increase your inspections once every 6 months. Make sure that you manage the cost side, so in the end you continue to have cash flows coming in, keep your tenant happy, and also you have a tenant that stays there for as long as possible. When you are investing in property, especially when your property portfolio is too small, one of the encouragement I would want you to keep in mind is that you need to be located where your investment property is, or you need to invest where you live or close to where your properties are. It is because when your property portfolio is too small and the property is very far away from you, the challenge you have is that of administration costs and maintenance costs. Everything you need to do needs to be done through a handyman or an agent, and these things are costly. So the first we said, make sure that you manage yourself, your emotional state, manage how you're thinking and how you talk about what is happening around you. The second thing we said, start managing your relationship with your tenant. The third thing is exploring ways of reducing your interest. There are interest rate strategies that you can explore. Yeah. The first is you need to have a clear understanding of what's happening to the economy. In this particular case, the economy is going into what people are predicting to be a recession, but it's also being overhyped. It might be a recession, it might not be a recession, but if it turns out to be a recession, how long do you think the recession will be? Listen to what people are talking and look at the evidence around you, around Australia, this economy. And look at the evidence around the world. Why is that important? If you are convinced this recession is going to be long, then you might want to fix your interest rate 100%. But if you are not sure, you might want a part of the interest to be fixed and a part of it to remain variable. Why is it important to first know the economy and what people are saying that you trust? It's because if you fix your rate and the recession doesn't occur, you will be paying a lot of money unnecessarily. So it is important that you sit down specifically with somebody and who will look at your cash flows. How much are you getting from these properties? And what is your budget? Just in case the properties don't positively cash flow, will it be able to cover a portion of the mortgage and the interest? So you can make a proper and informed decision. Make sure that before you rush to make interest rate decision to fix it or to leave it variable or to make part of it variable, know thy budget. The budget of your properties, what is coming in, what is going out, and what is your family budget, just in case things don't work out on the properties. How much are you prepared to dig into your personal budget to be able to cover for that shortfall? Because economics is not general. Everyone has their own economy. You create your own economy in your own house by what you actually do and decide with your money. When you are struggling in your own family, it doesn't necessarily mean everyone is struggling. Right now, as things are getting worse, interest rates are going up, it's very important for you to know that some people are making money, some people are happy. This is the best time that they've ever seen. So my final point, which I want to bring to your attention, is that property is one way of investing. So when interests are going up and you have invested in property and you are feeling in the pain, it means that whatever is causing you pain, there is someone at the end of another line who is enjoying. Who is that? You need to know who that is and see if you can also counter your pain by giving that same person who is enjoying your money so that you also are on the end of the other line. When property sector is struggling, there is another sector or a sector of the economy which is booming. Whereas interest rates are going up, who is benefiting is the banks.